I'm Joshua Dudgeon with Real Estate Investment Results. You can check us out at realestateinvestmentresults.com. All right, so I want to talk to you about the insurance behind a real estate portfolio or a real estate investment with us. Number one, we have hazard insurance. What does that mean? Well, hazard insurance is basically the same insurance that you'd have on your own house, so that if your house burns down, you get it replaced. We actually always have hazard insurance on every investment we do, including our new builds, because of the fact that if you're in the middle of the project and it burns down, then you actually are able to rebuild that project. And really, if a property ever, the joke in the investment market is, or when you talk to investors in general, is you never want a fire to happen, but when you do, you just hope nobody dies, because it's very good for your portfolio, because you always get to rebuild a higher value property back. So hazard insurance is crucial in an investment, a real estate investment, because of the fact that your dollars are tied to a real property, that if it burns down or if something happens in that way, you actually get your investment secured, because that money comes in to replace either the investment, or if the investment can't be replaced, those dollars come back to pay back the investor. The next one is title insurance. Title insurance is done through a title company when you close the property, and what it's doing is it's guaranteeing a clear title. When you have a warranty deed, it means that you have paid for a title insurance that then guarantees from the moment it's purchased by the investor, then that property, everything before that property that was against the property, any liens, encumbrances, mortgages, have all been satisfied. And if anything comes up from the moment that warranty deed goes on to before, that the warranty deed will actually fix it. The insurance will actually, they'll go after it and try to fix it without paying first. But let's say that they have to pay, that's what the title insurance does, is it pays to clear that title up, so that your note and mortgage that's attached to the property is clear of encumbrances, so that when we go to sell the property and return your money, we know that we have a clear title to go sell with. The final one is the final other security thing is the loan to value ratio again, which is 75% loan to value or less, which means there's a 25% buffer from whatever your investment dollars are to what the real value of the property is at the end. And in many times it's actually more than 25%. That means if the market dips by 8%, there's plenty of money between where your investment dollars are and where the finished value of the property is, so when you go to sell. If it dips 27%, then you would be underwater at 75%, but like I said, we actually have, many of them are below 75%. And our market rarely, even in the 07-08 crisis, the market on average did not dip below 10%. So it requires, it causes a very secure investment when you put all three together, the title insurance, the hazard insurance, and the loan to value ratio.